So welcome to all of you Shiksha 360, and today basically we will start our discussion on chapter number 24. Clear? Chapter number 24. This chapter basically we have to discuss in two parts. Chapter name is capital adequacy. Clear? Chapter name is basically capital adequacy. Clear? So in this session basically we have to discuss regarding the BASEL norms. Clear? BASEL norms and basically BASEL 2. Clear? So let's start our discussion, and I request to all of you, please go through the sessions very carefully, because directly they will ask straightforward questions from this chapter, and basically you have to understand the points. Clear? Just you have to understand the points, and I will tell you side by side, clear, basically which question they have asked every year. Clear? So let's start. First of all, basically we have to discuss under that basically how BASEL is formed. Clear? How BASEL is formed. Clear? So BASEL, it is actually a name of the location. Clear? Name of the location in Switzerland. Clear? Basically it is basically actually a name of the place in the Switzerland. Clear? So basically at this place, clear, at this place basically there is a meeting held. That is why basically it is known to be as a BASEL committee. Clear? That's why basically it is known to be as a BASEL committee. Clear? So basically initially basically when this is to be formed in the year 1975. Clear? In the year 1975 basically central bank governors of the group of 10 countries. Clear? Basically central bank governors, like you can say that like in India the central bank is RB. So can anyone tell who is the governor of the RB? So central bank governors of the country of 10 countries, clear, basically formed a committee. Clear? Basically central bank of governors of the group of 10 countries basically formed a committee of banking supervisory authorities in 1975. Clear? So basically in 1975 basically committee is formed. Clear? Basically by the 10 countries. Clear? By the 10 countries. Clear? Basically on which? On the banking supervisory, basically of banking supervisory authorities. Clear? Basically they have to overview or check the function of the banking. Clear? Basically how the banking is going on. Clear? So basically this committee, clear, this 10-member committee, clear, basically this 10-member committee basically usually meets at the Bank of International Settlement. Clear? Basically where they meet, basically BIS. Clear? So this committee basically usually meets at the Bank of International Settlement, BIS, basically in Basel, Switzerland. Clear? So basically where this committee meets, basically Basel, Switzerland. Clear? So hence it has come to be known as the Basel committee. Clear? So basically only basically they are basically meeting at the place Basel in Switzerland. That's why basically this is known as the Basel committee. Clear? That's why basically this is to be known as the Basel committee. Clear? So the Basel committee provides a framework for the capital adequacy. Clear? Basically how basically we have to maintain our capital. Clear? Basically the Basel committee basically provides the framework for capital adequacy in 1988. Clear? In 1988, which is known to be as the Basel 1 Accord. Clear? So basically Basel 1 Accord year basically 1988. Clear? And first meeting of this committee basically held 1988, and first meeting of this committee basically held in the year 1975. Clear? Initially it is a group of 10 members. Okay, so the 1988 Basel Code, clear, the 1988 Basel Code basically led to significant increase in the capital held by the banks over the following 10 years. Clear? Over the following 10 years. Clear? Basically what will happen? Earlier basically many of the banks failed basically due to not having proper policies. Clear? Basically due to not having proper policies or not regulatory guidelines. Clear? So that's why Basel comes into role. Clear? So that's why basically Basel comes into role, and basically we will now able to understand, clear, basically how it plays an important role. Clear? How it plays an important role here. Clear? Basically when we will discuss all these functions one by one. So the 1988 Basel Accord basically led to significant increase in the capital held by the banks over the following 10 years. It deserves a great deal of credit. Clear? Basically it deserves a great deal of credit basically for improving the stability of the global banking. Clear? Basically like as basically we have already discussed under the chapter number 15. Clear? Regarding the LCR and SFR and SFR. Clear? So basically all these basically we have to maintain as per the Basel guidelines. Clear? As per the Basel guidelines. Clear? Basically that is basically for the banking strengthen. Clear? Basically for the banking strength, so that the basically bank will not fail. Clear? So basically it deserves a great deal basically for of credit for improving the stability of the global banking system. Clear? However, it does have the significant weakness. Clear? Initially basically when any new thing is formed, if it has some positive points, so it has some negative points also. Clear? So now basically we have to discuss basically what are the negative points under the Basel 1. Clear? So the Basel 1 norms for risk weights basically were more of a straight jacket nature. Clear? Basically were more of a straight jacket nature. What is the meaning for that? Let's discuss. Very, very important. And you will get 1 mark question from this. Clear? we will expect 1 mark question in your examination in any of the set basically from this slide. Clear? So let's go through one by one. Like here, basically, what the BASEL 1 norm say that. Like, let's discuss a little bit. Like, any customer is visiting in the bank. Clear? Like, we can say that Ashwin visiting the bank for taking the housing loan. And here, basically, one more person is visiting the bank. We can say that Arun is visiting the bank so for same housing loan. And basically, when we take out, basically, first of all, basically, we will take out the symbol by taking the KYC. Clear? So basically, here, basically, we'll say that this symbol is comes out to be 640. And here the symbol comes out to be 720. And we can say that basically one more person visiting the bank, that is, we can say that location. Similarly for the housing loan. And the symbol of that person is basically, we can say that 780. Clear? So basically here, basically we will take 3 persons and having 3 different symbols. Clear? So basically, as per the bank policies, clear? So as per the bank policy, basically what is the policy say that basically if the person having symbol score is above 750, so the interest rate is basically, we can say that 6.9%. And if the symbol is between 700 to 750, the interest rate is 7.2%. And the symbol is basically, we can say that 650 to 700, symbol is 7.5. And if the 600 to 650, symbol is 8. Clear? So basically here, how much interest rate basically we will take from the location, that is 6.9. And here basically processing charges also given in that. Clear? If this is much is the good super. Here basically we will charge 8%. And here basically how much charge basically we will take 7.2. Clear? So basically here we can say that basically as per the rating of the customer. Clear? As per the rating of the customer, basically we will charge. Presently, basically we will charge different interest rate from the customer. Clear? So as per the rating of the customer, basically we will charge different interest rates from the customers. Clear? Different interest rates from the customer. Clear? So basically this is comes under the upcoming BASEL norms. Clear? But under the BASEL 1, clear? Basically under the BASEL 1, they will not check whether basically under that. Clear? Basically they have specified basically we have to take much this much security. Clear? For example, all exposure to sovereign means, clear, were given 0% risk weightage. Clear? So basically all exposure to sovereign is basically, we can say basically to different countries. Clear? Basically were given to 0% risk weight. Clear? Basically in that case, basically we have to say that basically 0% risk weightage. Clear? And all bank exposures basically have a risk weightage of 20%. Clear? Basically all bank exposures. Clear? Like basically you are funding to any another bank. Clear? You are funding to any another bank. So basically that has a risk weightage of 20%. Clear? That has a risk weightage of 20%. Clear? And corporate advances. Clear? Under the corporate advances basically has a risk weightage of 100%. Clear? Under the corporate advances basically had a risk weightage of 100%. Clear? Under the corporate advances basically had a risk weightage of 100%. Clear? So what is the meaning of that? Clear? Basically what is the meaning of that? That the bank has to capital. Clear? Like we can say that if they are giving a, we can say that just understanding, like basically we have 50 lakh. Clear? 50 lakh. Clear? And basically we are giving a loan to the any other bank. Clear? Basically we are doing funding to the any other bank. Clear? We can say that 20 lakh. Clear? 20 lakh. So here basically risk weightages of 20%. So basically 20% of that is basically 4 lakh. So basically banks has to keep 4 lakh in their hands also. Clear? Because there is a risk weightage of 20%. Clear? So basically there is a risk weightage of 20%. Clear? And corporate advances has a risk weightage of 100%. Clear? Corporate advances has a risk weightage of 100%. Clear? So basically it means that basically bank has to keep, like basically here basically bank has given a loan of 10 lakh to the corporate. Clear? So basically bank has to keep with himself also basically 10 lakh. Clear? Because there is a risk weightage of 100%. Clear? Basically there is a risk weightage of 100%. Clear? So basically they have to maintain that much capital in their hands also. Clear? So that in case in future if any mishappening happens, so basically they have the balance to maintain with that mishappening. Clear? or to balance that mishappening. Clear? So that is the meaning of that. Clear? So all exposures to sovereign basically were given 0% risk weightage. All bank exposures basically have a risk weightage of 20%, and all corporate advances basically have a risk weightage of 100%. Clear? So basically here they will not see that as per the BASEL 1, clear, whether that corporate is having good financial condition or not. Clear? Just they have given that basically there is a risk weightage of 100%. Clear? There is a risk weightage of 100%. Clear? Like we can say that, like as per the BASEL 1, clear, if all these three persons are visiting the bank to taking a loan, clear, so basically we can say that all have basically 50% risk weightage. Clear? All basically has, as per just basically we are thinking exam, assuming that basically all have to basically 50% risk weightage. Clear? So basically we can say that as a 50% risk weightage. So even their CIBIL record is very good. Clear? Even their CIBIL record is very good, but we have to charge interest rate. We can say that 7.8% to all the three persons, irrespective of their CIBIL score. Clear? Irrespective of their CIBIL score or irrespective of their credit rating. Clear? So this is the feature of the BASEL norm, and this is one of the main drawback. Clear? This is one of the main drawback. Clear? So basically such a rigid approach. Clear? Basically such a rigid approach basically without any consideration. Clear? Basically such a rigid approach without any consideration basically for the strengths or weakness. Clear? Such rigid approach basically without any considerations for the strength or weakness of individual entities, clear, was the main shortcoming of the BASEL 1 accord. Clear? Basically was the main shortcoming. Clear? This is one of the main problems. Clear? This is the one main problem of the BASEL 1. Clear? Basically was the main shortcoming of the BASEL 1 accord. Clear? Example, all loans by a bank. Clear? Basically example, all loans by a bank to a corporation. Clear? Basically all loans by a bank basically to a corporation have a risk weightage of 100%. Clear? All loans by a bank basically to a corporation basically have a risk weightage of 100%. Clear? And require the same amount of capital. Clear? And require the same amount of capital. Clear? And require the same amount of capital. Example, loan to a corporation. Clear? Basically with the AAA credit rating. Like same basically here we will discuss. Loan to a corporation basically with a AAA credit rating is treated in the same way as to a corporation with a B credit rating. Clear? As one to a corporation basically with the B credit rating. Clear? So this is one of the main drawback, clear, of the BASEL 1 norm. Clear? Of the BASEL 1 norm. Clear? Because in this basically there is not any importance given to the credit rating. Clear? There is not any importance given to the credit rating. They have given specific risk weightage to a specific sector. Clear? To a specific sector. Clear? And all these guidelines basically you have to follow basically while following the BASEL 1 accord. Clear? BASEL 1 accord. Clear? So that's why basically to remove this drawback, they have come with a new guidelines that is basically comes under the BASEL 2 guidelines. Clear? BASEL 2 guidelines. Clear? So I request all of you please remember all these points. Basically to the sovereigns, basically you have given 0% risk weightage. All bank exposure basically have a risk weightage of 20%, and all corporate advances basically have a risk weightage of 100%. Clear? Risk weightage of 100%. Clear? Basically BASEL 1 accord basically will not consider any credit rating. Clear? Either you have AAA credit rating or basically you have B credit rating. Clear? They will consider each person to be same. Clear? As the guidelines specified. Clear? As the guidelines specified. So the BCBS, clear, the BCBS basically released the international convergence. Clear? The BCBS basically released the international convergence of capital measurement and capital standards. Clear? Basically the BCBS basically BASEL Committee on Banking Supervision released the international convergence of capital measurement and capital standards. Clear? Basically a revised framework. Clear? Basically a revised framework. Basically when this framework was released, a revised framework on June 26, 2004. Clear? A revised framework basically was released on June 26, 2004. Clear? On June 26, 2004. Clear? So the revised framework, clear, basically was updated in the November 2005 to include trading activities and for the treatment of double default effects, and a comprehensive version of the framework, clear, was issued. Clear? Basically proper framework basically was issued in the June 2006, incorporating the constituents of the capital. Clear? Incorporating the constituents. Clear? Basically incorporating, wait a minute, was issued in June 2006. I think there is little bit content is missed. Clear under that? Clear? So basically you have to go through basically up to this much point. Clear? Clear? And the comprehensive version of the framework basically was issued in the June 2006. Clear? In the June 2006. Clear? So basically the revised framework. Clear? So here the revised framework. Clear? The revised framework basically seeks to arrive at significantly more risk sensitivity approaches. Clear? Basically here the revised framework. Clear? The revised framework basically seeks to arrive at a significantly more risk sensitivity approach to the capital requirements. Clear? So basically they will use or they will basically formulate more risk sensitivity approaches. Clear? So the revised framework. Clear? The revised framework basically provides a range of options. Clear? The revised framework basically provides a range of options for determining the capital requirements. Clear? The revised framework basically provides a range of options. Clear? Basically provides a range of options for determining the capital requirements. Clear? Basically for determining the capital requirements for the credit risk and operational risk. Clear? Basically for determining the capital requirements, basically for the credit risk and operational risk, to allow banks and supervisors. Clear? Basically to allow banks and supervisors to collect approaches. Clear? To select the approaches that are most appropriate for their operation and financial markets. Clear? Basically that are most appropriate for their operations and financial markets. Clear? Now basically they have given a responsibility to the banks. Clear? So the revised framework basically provides a range of options for determining the capital requirements. Clear? Basically for the credit risk and operational risk. Clear? Basically for determining the capital requirements basically for the credit risk and operational risk, to allow banks and supervisors. Clear? To select approaches that are most appropriate for their operational and financial markets. Clear? Basically for their operational and financial markets. Clear? First of all, here basically you have to remember that basically release the international convergence of capital market and capital measurement and capital standards. Clear? That is a revised framework. Clear? Basically on 26th June 2004. Clear? Basically when on 26th June 2004. Clear? Sometime basically they will ask this type of question also. Clear? Basically when they will release. Clear? Basically when they will release the revised framework. Clear? Basically when they will release the revised framework. Clear? And here basically the 1996 amendment. Clear? To the capital accord. Clear? Basically the in 1996. Clear? Basically they have do a amendment. Clear? 1996 amendment to the capital accord. Clear? Basically to the Basel code. Basically earlier market risk is not included. Clear? Basically earlier market risk is not included under that, but after later on basically they will include the market risk also. Clear? Basically later on basically they will include the market risk also. Clear? Earlier basically we have credit risk and operational risk. Clear? Now basically later on basically they have to include the market risk also. Clear? The market risk also. Now very important is, this is very important. The revised framework consists of the three mutually reinforcing pillars. Clear? So the revised framework, clear, of the Basel norms basically includes three mutually reinforcing pillars. Clear? The first question in your examination, which of the following is belong from the three mutually reinforcing pillars, or basically which one is not among the three mutually reinforcing pillars? Clear? So you have to remember that basically first one is the minimum capital requirement, second one is the supervisory review of capital adequacy, third one is the market discipline. Clear? Third one is the market discipline. Clear? So chapter number 24 is totally based on the minimum capital requirement. Chapter number 25 is basically based on the supervisory review of the capital adequacy. Chapter number 26, it is basically based on the market discipline. Clear? It is basically based on the market discipline. Clear? So basically we have to go through basically these three chapters. And basically chapter number 10. Chapter number 10 is also totally based on the Basel norms. Clear? Chapter number 10 is totally based on the Basel norms. If you are able to understand all these three topics along with the chapter number 23, so basically it lets very easy to cover the chapter number 10. Clear? It lets very easy to cover the chapter number 10 of module B. Clear? That's why basically we are discussing here one by one, step by step, so that basically when we are going to study chapter number 10, basically it seems very easy because we have already covered at all the content regarding that. Clear? So basically the revised framework. Clear? The revised framework is here basically consists of three mutually reinforcing pillars. Clear? First one is the minimum capital requirement. Second one is the supervisory review of the capital adequacy. Third one is the market discipline. Clear? Third one is the market discipline. So basically the Basel 2 capital requirement. Clear? So where it is applicable or where it is not. Clear? So the Basel 2 capital requirements applicable to internationally active banks. Clear? So basically it is applicable on which? Basically applicable or apply to internationally active banks. Clear? Like in the United States. Clear? Like in the United States, basically there are many small regional banks. Clear? Like in India also. Clear? Basically like in India also, basically we have public sector banks, small finance banks, regional rural banks, cooperative banks. So basically, in all these banks, are BASEL norm applicable or not? Clear? Basically, we have to understand also. Clear? Similarly, basically, we are taking the example presently in the US. Clear? In the United States. Clear? In the United States, basically, there are many regional banks. Clear? There are many regional banks. Like in India, basically, we have regional rural banks that is basically specifically for the rural areas. Clear? So in the United States, basically, there are many regional banks, and the US regulatory authorities. Clear? Basically, and the US regulatory authorities have decided that the BASEL 2 will not apply to them. Clear? Basically, they have given the guidelines that the BASEL 2 norms basically will not apply to them. Clear? Because there is a work culture is different in those banks. Clear? There is a little bit work culture different. So basically, it is difficult to maintain. Clear? It is difficult to maintain the BASEL 2 norms. Clear? Or the capital requirements. Clear? So these banks will be regulated under what is termed as BASEL 1A, which is similar to BASEL 1. Clear? So basically, they are saying that basically there is also regulatory guidelines, but not that as per the BASEL 2. Basically, that is BASEL 1A, which is similar to BASEL 1. Clear? Basically, which is up to similar to BASEL 1. Clear? It is likely that some of the larger banks, clear, it is likely that some of the larger banks basically may manage risks in a sophisticated way. Clear? It is likely that some of the larger banks, clear, basically may manage risks in a sophisticated way. Clear? In a well-behaved, in a well settled way. Clear? Like in Europe, all banks, clear, either they are to be large or small, will be regulated under BASEL 2. Clear? So basically in Europe, all banks are to become under the BASEL 2 now. BASEL 2. Clear? As basically BASEL norms are also formulated in the Europe. Clear? Europe, because Switzerland is one of the country of Europe. Clear? So in Europe, all banks, either large or small, basically will be regulated under the BASEL 2. In addition, the European Union, clear, basically the European Union requires the BASEL 2 rules to be applied to the securities companies as well as banks. Clear? So basically they even given guidelines that the European Union basically guideline that requires that the BASEL 2 rules, clear, that the BASEL 2 rules basically to be applied to the securities companies as well as the banks. Clear? As well as the banks. Clear? So you have to remember that basically the BASEL 2 capital. Clear? First of all, here the BASEL 2 capital requirements basically applicable to internationally active banks. Clear? Here basically we have discussed regarding the US. Clear? In the US basically it is not applicable on the small regional banks. Clear? And basically where what they have given guidelines, that is basically they have to be working under the BASEL 1A. Clear? And in the Europe, clear, all banks, clear, either they are to be large or small. Clear? In the Europe, basically all banks, either they are to be large or small, will be regulated under the BASEL 2 norms. Clear? Basically will be regulated under the BASEL 2 norms. Clear? So basically BASEL 2 revised framework. Clear? BASEL 2 revised framework. Once again, basically I will tell you basically 1 mark question from this. Clear? Basically 1 mark question from this. Clear? What is the pillar 1? What is the pillar 2? What is the pillar 3? Clear? BASEL 2 has 3 pillars. Clear? That is basically we have 3 mutually reinforcing pillars. Clear? Reinforcing. Clear? Basically which we have 3 mutually reinforcing pillars. So the pillar 1, clear, directly in the exam basically they will ask the pillar 1 is related to, clear, the pillar 1 is related to basically the minimum capital requirement. Pillar 2 is related to the supervisory review process. Pillar 3 is related to the market discipline. Clear? Basically pillar 3 is related to the market discipline. Clear? So the BASEL 2 norms have the revised framework and it consists of 3 pillars. Pillar 1 is related to the minimum capital requirement. Pillar 2 is related to the supervisory review process, and pillar 3 is related to the market discipline. Clear? Pillar 3 is related to the market discipline. Clear? You have to remember that what is pillar 1, pillar 2, pillar 3. Clear? Pillar 1 minimum capital requirement, pillar 2 supervisory review process, pillar 3 market discipline. Clear? Pillar 3 market discipline. So basically these things, basically minimum capital requirement like credit risk, new measurement, market risk, unchanged, operational risk, new. Clear? Basically we have to discuss all these things one by one. Clear? Basically what they have mentioning here. Clear? Like what is a work under pillar 2, and what is the work under pillar 3. Clear? Basically, we have to understand. So let's move. So the revised framework, clear, basically consists of three mutually reinforcing pillars: minimum capital requirement, supervisory review of capital adequacy, and the market discipline. Clear? And the market discipline. Clear? First, now let's start with the pillar 1. Clear? Under the pillar 1, clear, under the pillar 1, the framework offers three distinct options. Clear? Under the pillar 1, clear, basically the framework offers three distinct options basically for computing the capital requirement. Clear? Under the pillar 1, clear, the framework basically offers three distinct options. Clear? The framework basically offers three distinct options basically for computing the capital requirement. Clear? Three distinct options basically for computing the capital requirement. Basically for what? Computing the capital requirement basically for the credit risk, and three options for computing capital requirement basically for the operational risk. Clear? Basically for the operational risk. Clear? So these options for credit and operational risk are basically based on increasing risk sensitivity. Clear? Basically are based on increasing risk sensitivity. Clear? Are basically based on increasing risk sensitivity. Clear? So basically these options for the credit and operational risk are basically based on increasing risk sensitivity and allow banks to select an approach. Clear? And allow banks basically to select an approach that is most appropriate. Clear? That is most appropriate to the stage of the development of bank's operation. Clear? That is basically most appropriate to the stage of development of bank operations. Clear? So basically they have given three approaches. Clear? Basically they have given three approaches or three options, and basically we have to check out. Clear? Basically which we have to implement. Clear? Basically which we have to implement. Clear? Basically from these, this year, clear, on 6th of February 2022, basically they have also asked 1 mark question. Clear? They have also asked 1 mark question, and every year, clear, basically every year basically they will ask question from these. Clear? Basically from this. Clear? So let's go with that approaches. Clear? What they have given under the pillar 1. Clear? What are the three distinct options? Clear? For the computing the capital for the credit risk, for option available for computing market risk, and the option available for computing capital for the operational risk. Clear? For the operational risk. Clear? So the options available for computing capital for the credit risk. Clear? So first one is the standardized approach. Second one is the basically foundation internal rating based approach. Clear? Second one here is basically is to be the foundation internal rating based approach. Third one is the advanced internal rating based approach. Clear? So under the credit risk. Clear? Under the credit risk, first of all, basically you have to remember that. Clear? Here how you can remember. So the options available for the computing the credit risk, capital for the credit risk, for computing market risk, and for the operational risk. Clear? Standardized approach, it is common to all. Clear? Standardized approach, it is common to all. Clear? So you have to remember that basically standardized approach is common to all. Clear? Next one is foundation internal rating based approach. Clear? Under the credit risk, basically we have second foundation internal rating based approach. Third one is advanced internal rating based approach. Clear? Advanced internal rating based approach. Clear? So basically under the for computing capital for the credit risk, basically we have three options: standardized approach, then foundation IRB. Sometimes they basically they have given IRB, internal rating based approach. Clear? In the option sometimes basically they've given foundation IRB approach. Clear? Advanced IRB approach. Clear? Internal rating based approach. Clear? Second one, basically the options available for computing the market risk. Here basically standardized approach. Clear? Under the standardized approach, basically we have two, that is basically first one is the based on the maturity ladder and duration based. Clear? Basically based on the maturity ladder. Clear? First one that is basically based on the maturity ladder, and second one basically duration based. Clear? Second one here that is under the standardized, that is duration based. Clear? And next one here basically the advanced approach, that is basically internal models such as VAR. Clear? Such as basically VAR. And next one, the options available for the computing capital for the operational risk. Clear? For the operational risk. Clear? So basically advanced approach is also in all the cases. Clear? Advanced approach, advanced measurement approach. Clear? So basically here the difference is that is basic indicator approach. Clear? BIA. Clear? Under the operational risk. Clear? Under the operational risk, basically we have different approach, that is BIA. Clear? That is BIA, that is basically known as a basic indicator approach. Clear? That is basically known to be as the basic indicator approach. Clear? So the all the options basically we have discussed. So the options available for the computing capital for the operational risk: basic indicator approach, standardized approach, advanced measurement approach. For our options available for computing market risk, standardized approach, either it is to be the maturity ladder based or it is to be the duration based. Second one is the advanced approach, that is basically internal models such as VAR, clear, such as VAR. Here basically options available for computing capital for the credit risk. Basically, first one is a standardized approach. Second one is a foundation internal rating based approach. Third one is the advanced internal rating based approach. Clear, advanced internal rating based approach. Clear. Now, basically, what question basically they will ask in the examination? Clear. Basically, they will ask in the examination. Basically, which approach basically will be used in India? Clear. Basically, which approach will be used in India for these? Clear. Basically, like for computing the capital for the credit risk. Clear. Basically, which approach is used in India? Clear. Basically, for the credit risk. Clear. For the credit risk, basically standardized approach is used in India. Clear. Basically, this approach is used in India. Clear. Similarly, for the computing the market risk, clear, basically for the computing the market risk, clear, basically which approach is used in India? Clear. Next one, basically for computing the for operational risk, clear, like for the operational risk, basically we have used basic indicator approach. Clear. Basically basic indicator approach in India. Clear. Basically for computing the operational risk. Clear. Basically for computing the operational risk, basically basic indicator approach is used in India. Clear. Basic indicator approach is used in India. Clear. So basically this type of question basically they will ask every year in the examination. Clear. Every year in the examination, basically. So you have to understand, clear, basically which approach basically will be used. Clear. Basically which approach will be used in India basically for these specific risks. Clear. Basically for these specific risks. Clear. Like basically we have already discussed it, that is like standardized approach. Clear. Basically standardized approach for the credit risk, basic indicator approach basically for the operational risk, and basically banks shall continue to apply the standardized duration approach. Clear. Here basically we have not discussed, that is standardized duration based approach. Clear. Standardized duration based approach basically for computing the capital requirement for the market risk. Clear. Basically for computing the capital requirement for the market risk. Clear. So basically these 3 points, clear, basically these 3 points given in the green color, clear, basically will help us to score 1 mark, clear, in the examination. Clear. Basically standardized approach for the credit risk, clear, SAC, standardized approach basically for the credit risk, basic indicator approach. Clear. This is a different name. Clear. Basic indicator approach. Clear. Basic indicator basically for what? Operational risk. And standardized duration approach. Clear. Basically standardized duration approach basically for the market risk. Clear. Basically for computing the capital requirement for the market risk. Clear. So basically these are the important approaches, or basically these are the important ways basically which we will use for measuring the or for computing the risk. Clear. For computing the risk, so like for credit risk, standardized approach; for operational risk, basic indicator approach; and for market risk, basically standardized duration approach. Clear. Standardized duration approach. Clear. Because under that basically standardized approach, clear, basically we have discussed ladder, maturity ladder based. Second one basically we have discussed, that is duration method. Clear. Duration method. Clear. So basically here basically which we have to follow, that is duration method. Clear. That is basically we have to follow the duration method. Clear. So in this session basically we have to discuss up to this much point, and in the next session, clear, basically we have to continue with the 3 pillars of the BASEL 2. Clear. Basically 3 pillars of the BASEL 2 and some important numerical based calculations. Clear. Important calculation types question also. Clear. Like basically we have to discuss the CAR, clear, capital adequacy ratio, basically how we have to calculate, and basically how this formula is to be formulated. Basically we have to discuss all these things, and along with the numerical. Clear. Basically we have to discuss in the next session. Clear. Basically we have to discuss in the next session. Clear. So basically in this session basically we have just discussed regarding the basic of BASEL norms. Clear. Basics of the BASEL norms. Clear. So thanks to all of you for joining this session.